Welcome to Dominating Your Investments. I know I've been gone for a while, but I'm back and I want to talk about Nvidia today. We've seen a lot of negative news in the media around the decline, the pre-release of earnings and revenue, the decline in gaming segment. Uh, no surprise there. I mean, when we look at what's happened with COVID and all the acceleration that we had with gaming, and then now people going back to work, not surprised there. We also talk about the crypto winter that's coming and the decline in Bitcoin and Bitcoin mining. But that's not the story about this company. And so we're going to talk about my long-term thesis. We're going to break it up into a couple different little videos. I know your time is very valuable. And we're going to look at the financial standpoint. I know that everyone wants to see for the finances and do the numbers make sense? But more importantly, where do they align with my new 5P process, similar to what I had before, but a little more refined around what is the principle of this company? What's the mission? What are they trying to achieve? Do I believe in it that it can actually accelerate from here long term? You're not investing in previous performance when you invest in stocks. You're investing in the future. So what do I feel the future is for this company? What is the people like? The culture, the NPS scores for customers and internal, and can they keep employees for a very long time sticking to the mission and growing with the company? There's a lot of tribal knowledge that comes with that. And then also partners. How are they trying to scale the business? How are they trying to enable getting their message out and what they're trying to achieve and doing it at an accelerated, fast pace? And then the last two is around their planning and around sharing what the vision is of NVIDIA. Are they executing what they say they're going to do? And then are they getting public engagement and really changing the perspective on the company? And I think they're doing a great job on that. We'll talk in these 5 different P's around why these are so critical to keep shareholders up to date with what the company is doing. Why do I want to put my hard-earned money into investing in this company? Do I feel that they have the right approach, leadership, technology, product fit? And NVIDIA checks all of these boxes, but you don't have to take my word for it. It's not financial advice. But let's jump into the financials first, just so we can get that out of the way so you can feel comfortable around this company from a financial perspective. So you can see here that they're trading at 2.6% below the estimated fair value, according to Simply Wall Street. It's a great free app. It's not sponsored on this video, but I've been using it for over 2 years now, and it really helps you look at a company visually. The earnings are forecast to grow 22% per year, so that's very good. Earnings grew by 78% over the past year. So there may be some concern around the decline that we've seen in earnings, but you have to look at the whole picture when you look at NVIDIA and any company around what new products are they going to be coming out with. What's the overall vision? Is it a platform? Can it expand upon their current customer base? And when you look at just from a financial lens, a lot of the analysts miss this piece of it, and they just look at what's on the truck today. And so based on what's on the truck today and their projections, they only forecast 22% per year growth for the next 1 to 3 years. I would actually have to argue that it's going to be much higher than that. And now on to the competition. So we have Broadcom, Advanced Micro, Qualcomm, Texas Instruments, and many other semiconductor companies. Let's not forget Intel. This is a area that drives technology, that drives our world in moving forward with semiconductors. But NVIDIA is so much more than a semiconductor company, and you'll see that in the other videos. But we're going to stick to the financials. So let's just look at the 1 month. Okay, not a lot happening there. Actually, I take that back. If you got in at 150, man, you're pretty happy with just in 1 month, you're now at 179. And that just shows you it's really hard to time the market, because if you got in over here at 192 and you were thinking it was going great, now we're a little lower. But I'm a long-term investor. I hope that you take a long-term approach. We look at the 3 month and we see it's pretty all over the place. We look at the 1 year, could be even worse depending on where you got in. Now we look at the 3 year. Okay, now we're starting to see some serious growth. So 3 years ago, if you were to get in here at $41 a share, and you are now at 177. And if we look at the 3-year, if you were to get in the beginning just 3 years ago at $39, and now looking at roughly 180, 179, depending on the close, that is a huge gain, exponential gain over just a 3-year period. If we look at the 5-year gain, you can see it's very consistent as far as the large growth that we've had. And it actually had been even much higher when we're looking at the overall high 300s. So we've come down about 50% of value. Stocks are going to do this. They are going to move in ups and downs, but the longer you hold them, and as you'll see here on the overall max, going from 34 cents back in 1999 to now to 172 can be life-changing returns. And this company's been around for 28 plus years, and we'll dig into some of the things with those 5 Ps around the people and the principles and planning that have kept it continually growing over almost 3 decades now. Now, if we go further down, we can see we have some news announcements from SIGGRAPH conference on August 11th. We have here some different things about articles, people concerned about the crypto winter, and of course the big earnings miss that they pre-announced early, and the stock fell over 12%. And then if we go down further, we can see, okay, so fundamentals, let's look at this. The price to earnings ratio, that is a backward looking metric. 47 is very high, but when you look at paying for a company with huge growth potential, and you can see where it's going to expand those revenues and earnings, it's not so bad compared to other companies that are out there in the market. And we know they're profitable because of this. We see a price of sales 15. This company is moving into more of software as well as hardware, which is really encouraging when we look at those higher gross margins that we'll see. And in the last 12 months, we can see here $9.5 billion in earnings, almost $30 billion in revenue. So excellent net profit margin of 32%. It's going to be a huge decline from what we've seen here to what we're expecting to be officially announced at the end of the month. Gross margins are 65%. Debt to equity is lowering overall than what it's been when they made the Mellanox acquisition. And that will, I anticipate, to continue to lower unless they make more acquisitions. But we'll look to see that their balance sheet is actually really well intact. And I don't anticipate the drop in gross margin and net profit margin to be something that is long-term systemic. We know that gaming has gone down. There is a whole bunch of new graphics cards that are going to come and get released soon, so it should drive some upside. But overall, stellar financials when we dive into the balance sheet, and overall, I don't mind investing in a company that's doing $9.5 billion in a year of earnings when we're in a market where a lot of companies aren't even putting out free cash flow. So we look here, we have fair price to earnings ratio below fair value. Analyst forecasts are being really negative around the stock right now. I do anticipate a decline because of the macroeconomics. In my opinion, macro-wise, we're going to see a decline in a lot of stocks here over the next 6 months, especially with the new spending bill that just got passed. So inflation's not done, but if you're a long-term investor, you're not looking necessarily at all of this and saying, okay, I can't buy this stock now. You're trying to probably get the best price you can, but when you buy quality companies, you don't necessarily have to always catch the bottom. In fact, you probably won't catch the bottom. Let me rephrase that. But if you buy quality companies that can generate free cash flow, can continue to grow, continue to retain and expand their customer base, it's going to be a good investment the longer you hold on to that company. So we can see your great past performance, great health on the finances, and future growth. They actually do have a dividend. It's not a big dividend, but I think it's very strategic for them to keep that because it'll allow them to show the market they're always generating free cash flow and reinvesting in the business. They're buying back shares as well. And if they hold on to that dividend status for 25 years, they become a dividend aristocrat, which will entail get more investors over the long term. So value, it is not a value stock. It is definitely a growth stock. But if you're a long-term investor, you're wanting to see companies grow. So we can see here it's actually the most expensive semiconductor stock out there right now, besides AMD. And and after these earnings, actually, it will probably become the most expensive. But overall, these are great companies, but I'm more concerned around the growth and the projection moving forward and how they're expanding wider and building a platform. And we'll talk about this in our video about how I believe this company is going to be the compute platform of the next generation and redefine the internet as a whole, especially for the enterprise. So we're paying up for, that future growth and that anticipation. So we're close to a fair value right now. So we're not overpaying per se, but it's not a value stock. It's not like what Qualcomm's trading at. And Qualcomm's a great company as well. 5G semiconductor company with good growth perspectives. I have a little bit of that. But overall, when you look at the impact of what this company is going to be able to do for both the consumer and the enterprise, I think there's none other than what they're going to be able to do. Now, the projection for 38 analysts in the next year, 31% growth, I'd take that. I would definitely take that, right? For me personally, I'm just trying to continue to beat the market and compound my growth in good quality companies and be diversified. That is my goal. So upon when I do retire, I'll always be still working and plan on probably just talking about stocks for the rest of my life and generating the income I need, but wanting to make sure that they're continuing to grow and build up those exponential returns. So if you're beating 8% on an annual, 8-9% annually, you're beating the market when you average everything out. So future growth, future return on equity, revenue versus the market, great. High growth earnings versus the market, and earnings versus saving rate. The high growth revenue, I think they're giving them a ding because they are projected right now for 14%. You're always wanting to see 20, 30% revenue. Overall, this company is putting out excellent numbers when you look at the long-term trajectory. And they just had an off quarter in Q2. They could have less, growth in Q3 and Q4, which may open up other buying opportunities. That's why I'm such a big fan of dollar cost averaging. This has been a tough lesson for me to learn. When you think a company is going as low as it is and it can't go lower, typically wrong. A company can always go lower as news can hit, the macro can change. So it's good to understand the quality of the company and then slowly, progressively add into the position for the company. So right now we're looking at 378 earnings per share. We're going to obviously decline with the macro tailwinds and the over inventory glut that they have on their gaming chips. And then we look at, moving out 2 more years, and we're actually over 2.5 times that on earnings per share. And that's the analyst average. So return on equity, what are they returning back to the business? 48.3%. That is so much higher than the industry standard. So high quality there, high quality past performance, 25.8% historical annual growth. That's phenomenal. Very high net profit margins, especially for what is deemed in the market today as a hardware company, which I believe that is a wrong mislabeling of this company. And we'll see that develop over time, but more of a hybrid or compute platform, both with software, cloud, and hardware. And so we look at the last year performance, stellar. We're not going to focus on any more previously, other than the return on equity for previous return on equity was 35.9%. And then we go to a return on assets. I mean, all these numbers are stellar. They're just beating the industry averages by a lump sum. And so financially, $30 billion in assets, $5.5 billion in liabilities. Overall, their debt is covered. So if we go down here, we can see that their long-term liabilities is exceeded by their short-term assets. We go over here and there's really no concern because they're generating so much free cash flow. They could pay that debt off if they wanted to, and they have the tiny little dividend. And then we go into the institutional owners, and Jensen Huang has 3.3% still ownership of the company after 20 plus years, and totaling in $15 billion worth of stock. There was a lot of insider trading for the last 12 months. I think a lot of that's due to the macro, also with crypto being so volatile. But overall, you may have some new buying opportunities if it continues to decline. And if you're dollar costing averaging, you're going to have a lower cost basis, which will be good for the long term. So you can see here, institutions have not lost faith at all in this company, almost 65%. Insider owner, 4%. I'd like to see a little more than that. But the general public loves this stock as well, with 30% there. So shareholders have not been meaningfully diluted in the last year, not like some places like, I don't know, Palantir. Love you guys, but kind of getting sick of it. And make sure that we're buying back shares as well. And Vanguard Group, BlackRock, two excellent firms that are holding a large amount and are growing their position as well. You can see T. Rowe Price also 15% growth. So overall, I am super bullish on this stock. I've already done $30 billion annually in revenue, projected to do $40 billion by January 2025. Highly profitable, can cover their debt, and continuing to innovate. I showed you all the finances, and that's not even what excites me most about this company. See, that's a lot of it is on the past performance and the past products that they can sell and are generating. But if you pay attention to their investor day, you pay attention to their conferences and their coming up GTC conference in September 19th through the 21st, you'll see they're focused on the future and how they're going to redefine the internet, the metaverse, and how we interact together, both on the consumer level and on the enterprise. So check this next video out around that.